Anthony Bolton, by the way, has never really recovered from that. I meet people all the time who say, you know, Anthony still talks about the day you wrote that first column. I wrote 3 columns in a row about poor Anthony Bolton, and it was terrible fun. And the way advertising works in magazines and in newspapers is that the advertisers are never allowed to know what's going to be in the magazine beyond, or in the newspaper beyond, a few minor little things. So Fidelity knew that for 3 weeks there was going to be columns written about Fidelity. And so they naturally assumed that they would be positive. And they bought, for vast amounts of money, the facing page to my column to advertise Anthony Bolton's new fund. And then had it stuck there next to 3 weeks' worth of me saying, this fund is terrible, it's a nightmare, don't touch it, it's grotesquely overpriced, this man is letting us all down, etc. There was also, actually I'm not going to talk about Anthony Bolton, but now you've got me started, there was something he said when I went to talk to him about it. He was sent up to Edinburgh by his PR people. I live in Edinburgh. Sent to Edinburgh to talk to me about it, to try and persuade me that I'd got it very wrong and get me to, you know, write something else. And we talked in particular about how much he was charging for the fund, because I thought it was much too expensive. The fees were very high. There was a performance fee, and there was also an intermediary fee, a trail commission paid to advisors, which is very unusual in the investment trust world. And I spoke to Anthony about this, and I said, well, it's just wrong. You're ripping off the investing population of the UK who have this enormous trust in you. You're letting them down. And he said, if I was paid any less, I'd be letting myself down. That is off the record. Don't be spreading this around. Which was interesting for me because it was very, very symptomatic of the big problems in the financial industry being related to, you know, who gets the money, and very often it's not the investor. Anyway. Can I just ask, before I get going, how many Money Week readers there are here? I know obviously you're all going to be Money Week readers now, but who is a Money Week reader at the moment? Okay, good few, brilliant. And who's an FT reader? Okay, and who reads my column in the FT? Okay, quite a lot, brilliant. This is good. I've taken to asking this question since a rather disastrous outing in Liverpool a few weeks ago, where I was hired to speak in the evening, and I assumed they were asking me to speak at about 6 o'clock. It was a huge conference, 400 people odd there. So I arrived in Liverpool at about 5 o'clock, and Edinburgh to Liverpool, by the way, is no easy feat. It's nearly as hard as getting from Edinburgh to the Isle of Man. Finally arrived there, sat down, found that I wasn't speaking at 6 o'clock. In fact, I wasn't speaking until after dinner. I wasn't speaking until 11 o'clock. 500 Liverpudlian IFAs. The evening moves on, the fighting in the aisle starts. I said to the organisers, couldn't we move this forward just a little bit? And they said, no, it's all in the schedule, etc. I stood up, I asked if anyone read Money Week, blank audience. I said, does anyone read the FT? Blank audience. They didn't read the Money Week, they didn't read the FT, they had no intention of reading either of these things, and what's more, they believed their surprise speaker, and I was a surprise, not a good one, was going to be a northern sports personality who was going to tell them jokes. Instead of which they got a southern female macroeconomist who wanted to talk to them about the gold price. So suffice it to say, it went really, really badly. Now, you all look like a politer audience, so I'm feeling a bit more confident. Now, the chart that you have in front of you, I was in some trouble with your organisers last night, by the way, for not having very many charts, but it turns out it's very lucky I don't have very many charts because we can't put them on the screen. So you've got one chart, which embarrassingly is not updated, but if it was updated, it would look exactly the same. 5 years ago, I took this chart with me absolutely everywhere I went. And I put it up on the screen, which I would have done today, but obviously can't. And I made everyone print it out when they went home. I sent it out to participant after participant after participant of conferences. I said, I want you to print this out, I want you to stick it above your desk, and I want you to look at it all the time. And every time anybody says to you, things are normal, stock markets are fairly priced, property prices will never fall, any of this rubbish, look up at the chart, and you will know that none of it's true because nothing is normal. Then I stopped carrying the chart around, and I stopped showing it, because it seemed to me that by now everybody should know that interest rates are at 300-year lows. Everybody should know that interest rates have never been this low, that the lowest they ever were before was 4 times this level. Now I've started carrying it again, because people have forgotten. They have begun to think that this is absolutely normal. It's been going on so long that it feels normal. You know, people who are active in investing at the moment can barely remember a day when they weren't working with super low interest rates. I was saying to somebody last night, my youngest child has never visited a country in which the interest rate is more than 0.5%. He's 5, by the way, he's not that old, but... And when people talk about rates going up in the UK, they talk about them going from 0.5% to 1% to maybe 2%, peaking out to maybe 3%. It never crosses anybody's mind that where we are now is deeply, deeply abnormal, and normal would be something like 7% or 8%. You know, even now with inflation, let's call inflation 2%. We know it's higher, but let's pretend, to humour the government, that it is 2%. Normal base rates would be 2% above that, so 4%. So your mortgage rate would be 6%. No one thinks about that anymore. When they think about rates going up, they're coming in at a much, much lower level. So that's why I'm giving the chart out again, just so that I can give it to you, you can look at it, and you can remember that this is deeply, deeply abnormal. And wherever we go from here, we'll still be in an abnormal place. Now, it's the same with the country's finances. The last budget, I went on the radio quite a bit before George Osborne stood up to speak to talk about what might be in the budget, what might not be in the budget. And the only question I was ever asked anywhere was, what are the giveaways going to be? Now that we're back on a sound financial footing, now the debt problem is over, what's going to happen? Where are the tax breaks going to be? Where's the new spending going to be? And people really believed this. And still, I think, do. They've seen the deficit, not the debt, the deficit, beginning to come down little bit by little bit, and they believe that things have got back to normal. Now, we are nowhere near normal. We have, you know, one of the greatest debts ever. We have a deficit that, while it's down just a little bit, is still in the 4 or 5 biggest we've ever had. There is no debt reduction. If the economy was fixed, if we didn't need endless financial repression, if the banks were fixed, that line that you see at the bottom, that if it went all the way to 2014 would be a lot longer, would have started to tick up. And it hasn't. And that really matters. Now, it isn't just the case in the UK, of course, it's the case in the US, it's the case in China, all over Europe, etc. Everyone's working with super low interest rates. Everyone's having a go at repression, and everyone's at very different stages of the QE cycle. Now, there's another chart I used to carry around all the time, and if I had lots of charts, I'd bring this one as well. And I'll tell you what I'm going to do. I'm going to put charts together, I'll send them, and we'll get them distributed later. But this one, which again, I stopped carrying around and I stopped showing to people because I thought, well, you all know this. You don't need me to show you this chart anymore. And now I'm beginning to realize that, in fact, we still need this chart. The second one shows the S&P 500 against the expansion in the Fed's balance sheet. So you can see mapped. Every time more money is printed, the market goes up. There's a very, very, very clear correlation. Money, rise in the stock market. Now you look at that. Have you all seen this chart? You know the one I mean? Yeah. You look at that chart and you think to yourself, well, nothing else matters except for QE. I don't need to worry about anything when it comes to the stock markets, except for how much money is going to be printed next. Well, that's certainly what you thought a few years ago. But how many of you will have had, over the last 6 months, year, lengthy, but in the light of the chart, ultimately pointless conversations about valuations in America, about profits in America, about, relative valuations compared to bond yields, etc., etc. We spend hours talking about these things. We forget that this second chart, the chart of QE against stock market returns, tells us all we ever need to know. So I'm going to send you that chart as well. Stick that one up above your desk next to the one of interest rates to remind you that all the things you used to peg your expectations on are gone. Now, the fact that QE has driven markets completely nuts shouldn't really have been a surprise to anybody. But I want to talk about it briefly in terms of the less immediate consequences. It might not sound immediately relevant to investments, but I think over time it's going to become very, very relevant to all of our wealth. So I want to go back a little bit to Shirakawa-san, who was the last governor of the Bank of Japan. Now, he was very anti-QE. It really bothered him. And he spent a lot of time thinking about it, a lot of time talking about it. He made a lot of speeches to which nobody ever listened and which no one ever read the translations of, etc. But he made in these speeches one very, very interesting point that has not been picked up very well in the West. And I'm going to give you a quote, which sounds boring but is interesting. We have a column in the magazine, in our sister magazine, The Week, called Boring But Important, and this is one of those things. So just hang on for the quote, okay? When central banks try to create productive policy measures, In an environment where the effectiveness of traditional monetary policy is constrained, they naturally come close to the area of fiscal policy. As a result, the policymakers need to face up to the issue of who should be responsible for such policy actions in a democratic society. Now, what he was actually saying here was that very extreme monetary policy is not actually a monetary policy. It's a fiscal policy. And what he meant by that was that the way that quantitative easing, the way printing money and shoveling it into economies pushes up asset prices, and the act of transferring wealth is something that should be done by elected governments, not unelected academics, and that makes it a fiscal policy. So if you look at what happens, QE, it pushes up the price of assets for people who already have assets. It makes borrowing very cheap for American companies who want to borrow money and do lots of buybacks to make their executive richer. If you look at what's happened to GDP in the UK over the last 5 years or so, around 3/4 of it has come from financial services and business services of one sort or another. It comes from QE to the people who are sitting closest to the money. Now, it's not much discussed, but it isn't exactly a secret either. If you look at the statements from the Federal Reserve, they speak endlessly about the transmission effect, the wealth effect being the transmission effect of quantitative easing. And if you look at the Bank of England's publications, which absolutely no one ever does. Who is the Bank of England's quarterly review? Thank God I'm here, right? Now, in 2011, one of the quarterly reviews showed us exactly what the Bank of England expected to happen with their quantitative easing. And if we'd all read that, we'd all be an awful lot richer now than we are, although I'm sure we're all rich enough. Now, what it showed was, I'm going to send this chart to you because it's brilliant. It shows QE having what the Bank of England called an impact phase. And in this you see, there are 3 lines on it, and you see GDP and inflation kind of wibbling around at the bottom, just hanging in there in nominal terms. And then you see asset prices going like this, completely berserk. They expected this and they planned for it. It is absolutely not a surprise. Everywhere where there's been major QE, there's been a huge rise in asset prices, which was anticipated and part of the plan. The interesting bit is what happens next, because there's a second phase in the Bank of England chart, which we'll come to later, which shows something not nearly so nice happening. So when I was asked just before Christmas in another radio show to come up with one number that represented, for me, the problem with Western economies at the moment, my number was, this was the bottom line with Tim Harmford, by the way. I think you can still get it on iPlayer. My number was $90 million, which was the price that a piece of art had just sold for at Christie's in New York, and it was the highest price ever for a piece of art at auction. And to me, that represented the end of the line for QE, the final consequence of money printing, this huge rise in real asset prices, to the extent you can call a picture a real asset. If you look around you, you can see the other symptoms of it everywhere. You can see it in particular in London, for example. I don't know if you read the, probably don't get any London papers here, but I pick up the Evening Standard when I go to London, and there are constantly stories in it about people digging down in Holland Park, digging down 3 floors to make 16,000 square foot of new living space, because even for people who live in Holland Park, the price of houses has gone. So absolutely ballistic, you might as well dig down. Now, I'm being told that house prices are very high here. Anyone digging down? No? No underground swimming pools? So you've got house price growth in London at an 11-year high, double digits, even though in Northumberland you still can't get rid of a house for 40% below its original peak value. Very major changes here. This is why the 0.1%, not the 1%, the 0.1% have been pulling away from the rest of us as fast as they have. The main thing that has driven the rise in wealth equality that you hear so much about has been this deliberate policy of the central banks around the world. And that matters. It matters because it makes people cross. It matters because in the end it will give us proper inflation. But it also matters because a bad distribution of wealth impacts on long-term economic growth. And there's been lots of studies that show this, maybe they're true, maybe they're not, but there have been enough that there's critical mass behind the idea that you need a reasonably good distribution of wealth to create long-term economic growth. Now, my favorite one of these, and I'm afraid I'm going back even further now in history than Japanese quantitative easing, is something written by 2 local historians in Cheshire, Charles Foster and Eric Jones. They wrote a book called The Fabric of Society and How It Creates Wealth. I was going to say it's quite boring, but that's not really what I meant. It's quite academic to read, but it's worth having a go at if you've got nothing else to do. Now, what they did was they traced the social and economic conditions in 4 societies that were very big in the manufacture of cotton cloth between about 1200, 1780 or so. So that period in the middle, in northern Italy, Germany, Lancashire, and Holland. And they looked at how and why these areas had been so good at generating wealth when all the areas around them had very similar opportunities but didn't seem to be able to do it. And the answer came down to something very similar and quite clear. Each family, they had large numbers of families, all of whom had a small amount of capital. So wealth was very fairly distributed across the board. Foster says that then you saw vigorous technical and social innovation because many families had enough wealth to permit the innovators among them to experiment and establish their new ideas. Now, the point here is that each population comes with a relatively small number of innovators. So everybody in this room is clever, well-educated, has some interesting ideas, etc. But probably only one person in the room, if that, will be an actual innovator. And that innovator in each room has to have access to capital in order for you to see the innovation required for long-term growth. So that worked in each of these areas. But then something happened that will seem remarkably familiar to us today, which is that in those societies, some families and some groups worked it so that they ended up much more economically and much more politically successful than everybody else. They concentrated the wealth in their hands. So plural government turned to oligarchy, innovation declined, and the creation of wealth gradually fell off. So we take a very, very quick look at one village, because I'm always absolutely amazed by the existence of these records. One village, northern Italy, in 1243. 238 householders, and the top 50% controlled 80% of the wealth. Now that, in a modern context, is absolutely amazing. Because if you look at any of the big Western countries, some 20% control 60, 70% of the wealth. So it's a completely different thing. Similar figures exist for all the areas that he was looking at. And this was the time in which the quality of all the cloth they were selling, your silk, your wool, your cotton, massively improved, and when you get great innovation. Now, of course, with wealth comes greed. And that's when things start to decline. There's the concentration, there's families taking control of government, there's rising budgets, there's rising taxes, because once you've got people in charge, they need administrators, etc., etc. And you could see this if you went a little bigger and looked at the city of Florence in the 1400s, by which you could see the difference. 8% of the households had 80% of the wealth. Now that's a lot more where we are today. Came with some good things. You know, just as the Industrial Revolution here created a huge concentration of wealth and gave us some 150 ornamental lakes created by Capability Brown, this huge rise in wealth in Italy gave us the Renaissance. But it also meant that by 1700, there was no exporting textile business at all in Italy. The country was hardly rich at all. So it's just an attempt to draw a parallel between what happened then and what happened now with this new concentration of wealth. And, you know, as I speak, there are probably a good 150 hedge fund managers, ex-CEOs, etc., designing ornamental lakes for their own estates. And that'll be nice for future generations to look at, but it's probably not doing us much good at the moment. You know, when I speak in Scotland, there's always quite a lot of retired fund managers sitting around the place and a few ex-partners from Baillie Gifford, and I'm always pretty convinced that under the table, one of them is sketching out a lake design. So that's a good reason to have this second graph in your hands all the time, so that you can look at it and you can remember that a policy that was introduced initially to get rid of deflation, to prevent deflation, and to save the banks has instead become a policy of state-planned redistribution of wealth to the already rich. It's one of the greatest mission creeps ever. Now, my neighbour, with whom I have many gripes about the school run and all that kind of thing, she has on the back of her car a bumper sticker saying, "Will history be kind?" She's not a very good driver, so this is an attempt to stop people, you know, bumping her from behind and that kind of thing. But I think it's something, it would be a nice bumper sticker for every central banker to have on their car. Because I think when history looks back on this, they will say, what were these people thinking? They might have banished deflation for a little while, but they also created incredibly extreme social conditions that caused whatever's going to happen next, which is likely to be not great. If you come to Edinburgh, any of you, by the way, a friend of mine has Russell Napier. Anyone ever read Russell Napier's work? He's an Asian analyst. He is opening what he calls a library of mistakes, particularly for the financial industry. And in it, it is going to be filled with only books about financial crashes, general disasters, etc. And he is keeping an entire wall free for the books written over the next 20 years about the disaster that is modern monetary policy. So come see it in a little while. I'm going to stick with QE, I think, because it really is the most important subject out there. And I'm going to move on from talking about inequality to talking about how QE can or might create inflation. Now, if you listen to any economists at the moment, any at all, you will be absolutely convinced that you are living on the edge of a deflationary nightmare. You may wake up tomorrow morning and find that your money is worth more than it was yesterday. Luckily, there are signs all around us that, as usual, your money is worth less every single day. So when you worry about deflation, look at the price of stamps, up 6% on Monday. Look at the price of a bus ticket to the airport from my house to Edinburgh, up 8% this week. Look at the price of beef, all-time high. Look at the price of food in America, up 16% this year alone. Look at wages in Asia. This is going to make you feel a lot better if you're worried about your money being worth more. Wages in Asia going up 15, 16% a year. Look at the fact that even in Germany, there's beginning to be agitation for higher wages. And even in Germany, the price of an apartment in a main city, the price of an apartment in Berlin has gone up 50% in the last couple of years. Inflation just hasn't gone away. And that's partly because it never will, because in a proper democracy, you always have inflation. I'll tell you a story about yet another disastrous speech I made in Edinburgh a few years ago to, does anyone read Gillian Tett in the FT? Yeah, she's absolutely brilliant, really the best of the FT journalists at the moment. And she's always right about everything, and she has an answer to absolutely every question. So whenever you speak with Gillian, you know that you're in the presence of one of the greatest know-alls of all time, and that if there are questions, she will always be able to answer them. So we did a joint event for a charity, and we talked about, everything you would normally think of talking about in these circumstances, to an audience also full of know-alls. So by the time we came to questions, I was feeling a little bit tense, but thinking it's okay because Gillian will have this under control. And she did, and it went fine until the end, when somebody stood up and said, "It's so nice to have two female speakers at a financial event. I wonder if you two could give us your views on whether it is the case that all inflation inside Western economies has been caused by women." Which was, was a stunner of a question. And I looked hopefully at Gillian, who did fine, fudged it a little bit. But then we went away and we looked at it afterwards, and we found that the speaker had a real point. I'm digressing now, but it's quite interesting, so I'm going to tell you anyway. Which is that governments respond to any electoral event by promising people what they think they want. So before women have the vote in any particular society, welfare states are quite contained, because men don't really need anyone to educate the children better, or anyone to have a better health service, or anyone to look after old people, because women do that. So there's no need. But the second you give women the vote, politicians look around the place and say, how are we going to make these people vote for us? And then they start making the promises. We will look after your old people. We will educate your children. We will pay for university. We will this, we will that. We will there'll be free childcare, etc., etc. We're going to vote for independence in Scotland purely on the basis of getting 3 extra hours of childcare a week. Well, I am anyway. So if you look at the charts, you can actually map fiscal deficits in most countries to the point at which women were giving the vote. No, that's it, completely by the by, but I thought you might find it interesting. Now, another chart I will send you is of the price of essentials, back to inflation. As you might have gathered, there's a big fight we have in the office. John Steppick, who's my editor in the office, is convinced that we are entering this terrible age of money being worth more one day than it was the day before. And I am not with the programme on that at all. So I'm going to send you another chart of the price of essentials. Now, if we look at CPI, it's full of things that not all of us would consider to be essentials. So does it judge the inflation we feel in our life, or does it not? It's an ongoing argument. Some people think an iPad is an essential, some people think food is an essential, some people think new pairs of shoes are an essential. If you're under 30 and you live in London, you think a dry patch under Blackfriars Bridge is an essential. So it depends what you put in and what you don't. How much do you think inflation has risen? How much have prices risen since, say, 2005? Any guesses? 40%. 40%? You have a lot of essentials. 20%? It's about 25%. It's about 25%. And that's fascinating in itself, that in under 10 years, our money has lost a quarter of its value, with practically no comment. Everyone thinks inflation is very low, but your pound is now only worth 75p. Amazing. But if you look at what we would actually consider to be essentials, utilities are up 100%, food, transport, fuel, these things are all up 50% plus. If you were to make a new CPI, only putting in things that are absolutely essential, in 2011, 2012, inflation in the UK would have been running at 11%. Last year, when our official CPI was about, 2.5%, it was running at nearly 5%. Now they're kind of even, so there's not that much difference above it. The essentials is a little higher than the CPI. But nonetheless, if you have had the feeling over the last 5 years that someone isn't telling you the whole truth about the deflation story or the inflation story, then you have been absolutely right. So the point is that inflation is out there. It's just not in the places where you normally look for it. So we have to find some different places to look for it. And one place where I think you can look, where you will see something beginning to happen that is indicative of a coming rise in inflation, is something very modern. It's crowdfunding. Anyone invest their money in any crowdfunding, peer-to-peer websites, anything like that? Yeah? Now, this is interesting. I interviewed someone for the magazine this week, an American economist, and she made the excellent point that money is like water. It always finds its way to where it can find the highest return. You can block it wherever you like, but it trickles through economies and it finds where it's going. And in the UK, like in the US, we have a situation where savers are awash with cash. You know, and a deposit account that pays more than 1% is still like gold dust. Yet people who are prepared to borrow at 5%, 6%, 7%, 8% can't find anyone to give them money, or not without very high fees. You know, I met with some people the other day who'd been offered a short-term loan, which they were quite pleased with because they only wanted it for a year, until they found out the arrangement fee. On top of their interest rate, they were paying an 8% arrangement fee for a 12-month loan. Perfectly solvent business. So it's a strange situation. But what you find is that obviously the money getting 1% is going to find the money offering 7%. And that is happening now with our new shadow banking system. Peer-to-peer lenders, crowdfunders, factor invoicing, invoice factoring, corporate lenders. There are some new funds launching on the AIM market, which are designed purely to lend money to SMEs. So it's not very big yet. In fact, it's still quite small, under £1 billion in the UK. But nonetheless, you see this here, money finding a way. It's not finding its way through the banks. There isn't credit creation in the same way, but money is finding a way to move. And that matters because the velocity of money is the beginning, and it's very, very disruptive. One other thing you might want to watch, actually, when thinking about inflation, and this occurred to me when we were talking about Scottish independence again the other day. I'm afraid it's all we talk about in Edinburgh at the moment. You will have seen oil revenues, tax revenues from oil coming down very substantially and slightly skewing the case for independence. And that was all about capital expenditure, huge amounts of capital expenditure. If you look across the entire oil industry, you will see the same thing. Capital expenditure in the oil industry has gone up 5-6 times in the last 5 years, with almost no effect at all on supply. That's fine, as long as the global economy stays where it is. If China continues to slow, we don't have to worry about that. If global growth picks up, if China stimulates it again, you really, really have to watch at the pump what happens. Inflation comes very suddenly when it comes, and there are beginning to be little signs out there that make me think it's what you should be worried about. Right, so the brief that I got asked for forecasts. There you are, you have forecasts: inflation, inequality, social unrest, ongoing financial repression, lots of hopeless people constantly forgetting that just because something has been going on for 5 years doesn't make it normal. The other thing that I was asked to talk about today was unusual, actually. What you shouldn't invest in. Normally I get bits of paper saying everyone wants to know what they should invest in. Everyone wants to be rich. But this said, what shouldn't we invest in? The first answer to that, actually there are so many answers, hard to know where to start. But let's move on briefly from crowdfunding, which I was talking about just now. Look at crowdfunding and you instantly think, well, I don't want to invest in in UK banks. Very straightforward, simple conclusion. Don't go anywhere near the banks. They're about to be subject to an incredibly disruptive technology that is going to destroy their businesses over a certain period of time. You know, they have a great proposition. We were talking earlier about a new one coming out called Money & Co., launched by Nicola Horlick, where you will be able to automatically diversify your money for a return of 5 to 6%, which is fabulous compared to what you can get in a deposit account. So don't buy banks. Don't buy most FTSE companies, actually. There's a lot of failing businesses there. Don't buy US shares. Now, we talked earlier about how nothing matters except for QE, but let's look at if QE didn't exist, let's look at the reasons why you wouldn't buy American shares. You wouldn't buy them because valuations are far too high, because history tells you that if you buy at these levels, you always make a crappy return over a decade. You wouldn't buy because, well, they're expensive on short-term measures, Ps, on long-term measures, cyclically adjusted Ps, because the S&P has just hit a record high because it's had its longest quarterly run of rises for, 8 years or something. Because all those valuations price in rising profit margins when you're much more likely to see falling profit margins. If you look at the last 20, 30 years, we always try and look at Money Week at things in 10-year periods rather than in 6-month periods. If you look at the last 30 years, you will see that big companies in the West have had the most amazing time, profit-wise. They've seen everything has been working in their favor. Corporate tax rates have come down and down and down. Interest rates have come down and down and down. It's become easier and easier to raise debt. And on top of all that, I'm echoing now, aren't I? No? Just at me? Okay. I'm echoing at me. And at the same time, you've had these corporate incentive packages for our CEOs, which have incentivized them to keep profits very, very high. Now, that's come at huge cost in terms of wages being kept very low, huge cost in terms of capital expenditures being kept very low, but it has kept profits very high. Now, we think that all these things are at long-term turning points. Of course, interest rates are at long-term turning points. Corporate tax rates may come down, but one way or another, the corporate tax take is going to rise. People will be made to pay more, regardless of what the rate is. And there's beginning to be a big sea change in the way that CEOs are compensated, which will again have an effect on short-term profits. All these things will affect valuations. So there's plenty of reasons to steer completely clear of everyone's favourite market before we even get to the tapering. Now, Janet Yellen is thought of by most people as being a bit of a dove. She's not going to raise interest rates. She's going to taper less than you think, and if anything goes wrong, she's going to pull back on the tapering. This is entirely possible, entirely possible. You know, she's on record often as saying that she thinks that Japan finished its last round of QE too early and that that was the problem in the 1990s. I don't agree, but that's what she believes, or she says she believes. But, something has happened in America, and that is that bank lending is rising quite fast. It's begun to move, and you cannot, in any academic justification, have quantitative easing and rising bank lending at the same time. And we know there are signs of inflation. The Federal Reserves, they know, in the US, they know there are signs of wage demands, etc. So it may be that Janet Yellen actually turns out to be the voice of reason among the world's central bankers, and that we begin to see an outbreak of common sense, if you like, whereby we see inflation, we see bank lending rising, and the QE has to stop. And then we get into, we're going way back here to chart number 3, which you'll get soon, where we had the impact phase of QE, and then we have the adjustment phase of QE. And the adjustment phase of QE is really, really scary. Go back to that quarterly report, look at the chart, and you see that as soon as we move into the adjustment phase, the end of the money printing, that market, all asset prices, start to go down again, and they fall, and they fall, and they fall, and they fall, until they hit the level they would have been at if they'd risen with nominal GDP. It's a very, very long fall from where we are today. And you know, the Bank of England doesn't get everything right, but they got the impact phase exactly right. So I think you need to pay some attention to what they say will happen at the end. That'll be good for the dollar, by the way. It'll be something worth buying, but very, very bad for QE. So I think in general, this is a manipulated market. It's an overpriced market. It's a very, very dangerous market. And if you want something very clear to not buy, don't buy this. Still? Okay, fine. We talked last night at supper. I had dinner with your directors last night. Very, very interesting. We talked about Russia. And whether you should buy Russia. You should avoid Russia because it is very, very risky, is the general view. It's very, very, very risky. And I agree. It's incredibly risky, unbelievably risky. You know, Putin might be mad, completely mad. Corporate governance is awful. Asset confiscation is a major, major risk. But successful investing is about buying at a price that discounts risk. And the US at the moment does not discount any of the risks. None of the risks we've talked about are in the price. Only good stuff is in the price. The Russian market, on a PE of 3-4 times, discounts pretty much every risk there is. It's already discounting a return to communism. It's already discounting multiple invasions. It's not quite, we were talking about this last night, not quite discounting blood on the streets in a major way, but it's discounting pretty much everything else. So if you were to ask me today, do I want to hold Russia or do I want to hold America over a 10-year period? For me, the answer would always be Russia, because we buy on price for a 10-year period. And history tells you, if you buy, I mean, you know, investing is really so easy, isn't it? If you buy at a very high price, you won't make any money. If you buy at a very low price, you probably will. But over a 10-year period, which of course is why it's so much nicer to be a retail investor than an institutional investor, because if you're a retail investor, you don't care about what happens over 5 years, you only care about what happens over 10 years. I feel like I've been talking too long. I can tell you more things not to buy, or we can go straight to questions and you can ask me what to buy. What do you think? I'll tell you briefly though what I wouldn't buy. I wouldn't buy much in the way of European shares until you see the QE starting. I would keep buying Japan because the sales tax is a red herring, and there will be another marvellous round of QE coming there. And then, of course, I would buy the thing that is the answer to all our problems. Money Week readers, what is the investor's answer to every single problem out there? That's a good answer, but it's not the right answer. Yes, it's gold. The answer to everybody's problems. Now, it may not be the answer to everyone's problems in that it may be confiscated by governments if there is very high inflation. But apart from that, we still say that everybody should hold a certain amount of gold because it is the only real insurance you can get against all the horrible things that we keep forecasting happening.